If you're approaching age 73 with money in a traditional IRA or 401k, the IRS has a surprise waiting for you that could cost you $50,000 or more in unnecessary taxes. The rule is called Required Minimum Distributions, or RMDs. Starting at age 73, you're forced to withdraw money from your retirement accounts whether you need it or not. Every dollar you pull out gets taxed as ordinary income, pushing you into higher tax brackets and triggering Medicare surcharges. But here's the good news. With the right strategies, you can legally reduce this tax burden by tens of thousands of dollars. In this video, I'll show you exactly how RMDs work and the 3 most powerful strategies to minimize the damage. Let's dive in. Required minimum distributions are mandatory withdrawals from your retirement accounts starting at age 73. Here's the basic concept. When you contributed to your traditional IRA or 401k, you got a tax deduction. The government let you defer taxes with the understanding they'd collect later. Well, later starts at age 73. Thanks to the Secure 2.0 Act passed in 2022, the RMD age is now 73 for anyone born in 1951 or later. If you were born in 1960 or later, it's age 75. Here is how the calculation works. The IRS takes your account balance from December 31st of the previous year and divides it by your life expectancy from their actuarial tables. Example: if you have $500,000 in your IRA at age 73, and it gets worse, your RMD amount increases every year as the divisor gets smaller and your account potentially grows. By age 80, you could be forced to withdraw $30,000 or more annually from that same account. Which accounts have RMDs? Traditional IRAs, SAPE and simple IRAs 403BS and 403FES and 457B. Sent the only major account exempt, Roth IRAs. One critical point. If you miss your RMD, the IRS penalty is 25% of the amount you should have withdrawn. That's $5,000 on a missed $20,000 RMD. Plus you still owe income taxes on it. Your deadline is December 31st each year. Don't miss it. Here's why RMDs are so damaging. They don't just increase your tax bill, they trigger a cascade of other costs. Tax bracket stacking. Let's say you're married filing jointly with income of $90,000, comfortably in the 12% bracket. Your RMD of $30,000 pushes you into the 22% bracket. That's nearly double the tax rate on that extra income. Medicare surcharges, IRMAA. This is the real killer. If your modified adjusted gross income exceeds $206,000 as a married couple, you'll pay an extra $419.90 per month per person for Medicare Part B. That's over $10,000 extra per year in healthcare costs, triggered by RMDs pushing you over the threshold. Social Security taxation. Up to 85% of your Social Security can become taxable when your income exceeds certain levels. RMDs push more of your Social Security into taxable territory. The real math for a couple with $750,000 in IRAs over a 20-year retirement will withdraw approximately $550,000 in forced RMDs federal taxes at 18% average rate, $99,000 Medicare IRMAA surcharges, $10,000, $15,000 additional Social Security taxes, $15,000, $25,000 total, $120,000 to $140,000 in additional lifetime taxes. With proper planning 5 to 10 years before RMDs begin, you could reduce this by $50,000 or more. That's the tax trap, and that's what we're going to fix. If you're charitably inclined, this is the single best RMD strategy available. A qualified charitable distribution lets you donate up to $105,000 per year directly from your IRA to a qualified charity starting at age 70. The money never appears as income on your tax return, and it counts toward your RMD requirement. Why this is powerful? The donation satisfies your RMD without increasing your adjusted gross income. This means no tax bracket bump, no IRMAA Medicare surcharges, no increased Social Security taxation. You're supporting causes you care about. Example: your RMD is $20,000, and you normally donate $6,000 annually to charity. Instead of taking $20,000 as taxable income, then writing a check, direct $6,000 from your IRA to charity via QCD, take only $14,000 as taxable income. The $6,000 counts toward your RMD at the 22% tax bracket. That QCD saves you $1,320 in federal taxes every single year. Important QCD rules. Must go directly from your IRA to a 501(k) charity. Cannot also claim the charitable deduction. Cannot go to donor-advised funds. No goods or services in return. With today's high standard deduction, most retirees don't itemize anyway, making QCDs more valuable than traditional charitable deductions. This is the most powerful long-term strategy, but it requires planning years before age 73. The concept: voluntarily convert money from your traditional IRA to a Roth IRA. You pay taxes on the conversion now, but once in a Roth, it grows tax-free forever. Withdrawals are tax-free, no RMDs during your lifetime. Better inheritance for your heirs. The key is doing conversions in your low-income years, typically between retirement and age 73. Real example: John and Mary, both 66, just retired with $800,000 in traditional IRAs, $40,000 in Social Security, no pension. They're in the 12% tax bracket with room before hitting 22%. Smart move: convert $25,000 per year for the next 7 years. The results? 7 years times $25,000 equals $175,000 converted. Tax cost: $21,000 over 7 years at 12%. Remaining traditional IRA at 73. Much smaller, meaning lower RMDs. Without conversions, with conversions, their RMD on $780,000 would be $29,500, keeping them in a lower bracket, with $175,000 plus in tax-free Roth accounts. Over 25 years, this saves $60,000, $80,000 in taxes. Critical Roth conversion rules. 1. Conversions are permanent, no reversals after 2017. 2. Pay the conversion taxes from non-retirement money if possible. 3. Watch out for IRMAA large. Conversions trigger Medicare surcharges 2 years later. 4. If moving to a no-tax state like Florida, consider waiting to convert the sweet spot. Convert systematically during ages 60 to 72 to permanently reduce future RMDs while paying taxes at your lowest rates. The third strategy is about being smart with your withdrawals before and during RMDs. The mistake most retirees make: they touch their IRAs as little as possible in their 60s and early 70s, thinking they're preserving wealth. But this creates a tax torpedo where massive balances trigger huge RMDs later. Better approach: be intentional about drawing down traditional IRAs in your 60s when you're in lower tax brackets. Example: Sarah retires at 62 with $800,000 in an IRA. She lives frugally, barely touching it for 11 years. By 73, it's grown to $1.3 million. Her RMD is $49,000, pushing her into the 24% bracket and triggering IRMAA. Alternative: Sarah takes $30,000 yearly from her IRA in her 60s, even though she doesn't need it. She uses it for travel and gifts to kids. By 73, her IRA is $700,000. Her RMD is just $26,000, keeping her in a lower bracket. The withdrawal sequence: ages 60 to 72. Live on taxable accounts and do Roth conversions. Take strategic IRA withdrawals to fill lower tax brackets. Age 73 plus. Take RMDs early each year. Supplement with tax-free Roth withdrawals if needed. Don't be penny-wise and pound-foolish. Strategic spending in early retirement can save tens of thousands in taxes later. Let's make this practical. Here's what to do based on your age. If you're 60 to 65, calculate your future RMDs using an online RMD calculator. Start. Roth conversions: if you're in a lower bracket now, then you'll be at 73. Consider delaying Social Security to create more Roth conversion space. If you're 66 to 72, this is your prime Roth conversion window. Use it. Calculate how much you can convert yearly without hitting IRMAA thresholds. $206,000 for married couples. Review your beneficiary designations. If you're 73 plus, set automatic RMD reminders for early December. Implement QCD strategy immediately if you're charitable. Continue Roth conversions if you have large balances. Work with a tax professional to optimize year-by-year common mistakes to avoid. 1. Waiting until December to take your RMD. Do it early too, not withholding enough taxes from distributions. 3. Forgetting that each 401k requires separate RMDs, unlike IRAs which can be aggregated. 4. Doing massive Roth conversions in high-income years. 5. Not coordinating with your spouse's accounts. The most important step: start planning now. If you're in your 60s, you have time. If you're 73 plus, you can still optimize with QCDs and smart withdrawals. The $50,000 IRA tax trap is real, but you're not helpless. The retirees who get hit hardest are those who don't plan ahead. They wake up at 73, start taking massive RMDs, get pushed into high tax brackets, trigger Medicare surcharges, and watch their retirement income get eaten by taxes. But with 3 simple strategies: Roth conversions in your 60s, QCDs for charitable giving, and smart withdrawal planning, you can reduce your lifetime tax burden by $50,000 or more. The most important step: start planning now. If you're in your 60s, you have time. If you're already 73 plus, you can still implement QCDs and optimize your withdrawals. The tax code is complex, so I strongly recommend working with a qualified tax professional or fee-only financial planner who specializes in retirement tax planning. The money you spend on good advice will be paid back many times over in tax savings. Remember, the IRS isn't going away. Your RMDs are coming. The only question is, will you be ready? If you found this helpful, hit the like button and subscribe for more retirement tax strategies. And drop a comment below. What's your biggest concern about RMDs?